Well, hi everyone, and welcome to the Buffett and Beyond Research Stock of the Week. And this week we're going over Darden Restaurants. And right now this stock is doubling the S&P 500 this year, and it's paying a 2.8% dividend. And at the beginning of the year, when we put it into our portfolio, it was paying about 3.3% dividend. So it's gone up since then, which means the dividend has gone down for a while until it goes up. But it's growing its dividend, which we're going to see in a minute. So let's go to Darden Restaurants. And remember, folks, if you want to walk on this beach like Jimmy Buffett once did, you've got to learn how to invest even better than Warren Buffett does now. And let's go over this stock. It was founded in 1968 as Red Lobster, and Darden is a leading American restaurant company that owns and operates a portfolio of popular restaurant brands. But it no longer owns Red Lobster. It sold it a couple of years ago, and Darden's expanded its banners through acquisitions, including iconic full-service restaurant chains such as Olive Garden, Longhorn Steakhouse, Cheddar Scratch Kitchen, Yard House, The Capitol Grill, Seasons 52, and Bahama Breeze. Now let's look at some overall pictures, and we can look at the clean surplus ROE. And when we look at this clean surplus ROE, we want to think of a bank account. The average stock, the average large cap stock is paying about, or has a clean surplus ROE of about 13.5%, and Darden with 19.7%. So it's doing better than the average stock in its return on shareholders' equity. Now, its net income is below the average stock, so that doesn't make us happy. But of course, the whole restaurant industry, or the food service industry, is not doing that well over the past couple of years. Revenue better than the average stock, with the average stock bringing in 7.1%, or growing their revenue at 7.1%, and Darden with the revenue of 9.5%. The problem is it's not going to the bottom line as efficiently because it has competition out there. And that's the thing with the restaurant business, folks. It's got competition. And one of the things I want to bring out, that if you bought this stock 15 years ago, you would have received, look at these dividends here, you would have received $52.93 through 2027. And you could have bought it back in 2013 as low as $25 a share. So in other words, the dividends that you received if you bought it 15 years ago, and I know it's 15 years sounds like a lot, but all of a sudden I have people that have been listening to our radio program when we had it, and our newsletter, which we've had for a long time now. All of a sudden 15 years is gone. There you would have received double the amount that you paid for that stock in dividends alone, plus the price has gone up, and we'll look at a chart of that in just a few minutes. Now, the retention rate is less than 50%. When we talk about a growth stock, we want to see retention rate of 100%. So it could invest 100% of its money back into itself in order to grow. And you can see that Darden is not doing that, so it falls into our family of dividend growth and income portfolios. Now, when we look at the net income growth, we already said on average 8.7%, which is below the 13% of the average stock. Revenue growth 9.5%, 5-year average, which is higher than the average stock. But look at 2027. Well, let's look at 2026 first. We could see above average. We like this dividend growth rate of 8.9% in here, and net income growth of 12.2%, revenue growth 11.2%. But for 2027, the outlook is not as bright for this stock, and that's our problem with this stock right now, as we've had it for a while, a long while, and we've had good numbers up until recently. But even this year, it's outperforming the S&P, as we're going to see in a minute. Years to pay debt, this is Buffett's rule of thumb. If a company takes all the money it's making and uses it to pay off the debt, how many years will it take to pay that debt? His rule of thumb is 5 years or less. Our rule of thumb is 3 years or less. So it could pay off its debt in about less than 2 years, and we kind of like that. So Therefore, it's making enough money to pay that dividend, and that's what we like to see. Now, the recent dividend, as of just the other day, or actually as of yesterday, is 2.8%. And remember, we had this stock at the beginning of the year at 3.3%, but we've had it up to as high as 3.8%, depending on the price of the stock. So the dividend has been growing nicely up, but the projections for next year are just not as really where we want to see them, even though it's been a good stock to us. Now, looking at the year to date, black line is the S&P 500, and the blue line is Darden, and we can see the S&P has grown about 7.6, 7.7% as of the other day, and this stock is up more than double that at 18%. So year to date, it's done very, very well. And over the past 5 years, again, black line is the S&P 500, up 72, call it 73%. This stock up 80%, but this 80% appreciation does not count those dividends. The $52 in dividends over the past 15 years and about $30 in dividends over the past 5 years. So that's what's the good thing about this stock. That's why we have it in our dividend growth and income portfolio. It's growing nicely with the market. It's paying a higher dividend, and over the years, it's been growing that dividend nicely. It's just next year that we're looking at things slowing down, and so we're not sure if we'll keep this stock, but we'll go over it before the end of the year to see if it'll be in next year's portfolio or not. So, folks, what's our goal out there? Well, it's to build our wealth faster and safer with better than average stocks. And one of the things that we use the dividend income and growth portfolio is for as you get toward retirement, actually at 50 years old or so, you want to be able to start a part of your portfolio into dividend and growth stocks. Why growth at all? Because you want to keep pace with inflation. You want to more than keep pace with inflation. That dividend that comes in our portfolio is about 3.5, 3.6, 3.7% per year. That if you use those dividends to pay your bills as you think about retirement, you're going to think about Social Security, you're going to think about other pensions, you're going to think about all your bills. And when you put all that together, how much do you need to live on where you don't have to sell your stocks? You use the dividends from the income part of your portfolio. If we get into a downturn in the stock market, we suggest about 3 years of treasury bills, and the treasury bills shouldn't go out more than 3 years, so they're very, very safe in the short term, because with longer term treasuries, rising interest rates can hurt those returns. You want T-bills no more than 3 years so that you can take that money and spend it in case of an emergency, because you want an emergency to be temporary inconvenience and not a disaster. So therefore, you want enough income to be paying all your bills, and then you want some money put aside in T-bills, which are earning over 3.5% right now. Want some money in those T-bills in case something comes up where you need cash. That's what you have. In case of a market downturn and you need money, you don't want to be selling your stocks that are going down, even though they're good companies, because especially since they're good companies, they will come back, and they always have. So you want to build your portfolio faster and safer than the average stock out there. So, folks, we had another crazy week this week, but we're going into the 4th of July celebration, so possibly next week should be a better week than this week. It should be an up week, usually going into a 3-day holiday. So you take your mind off the market, go out, be with your family, enjoy yourself, stay safe, stay healthy. We'll see you back here in a couple of days.